What's going on, guys? Bexio, and today we had a brand new video with Jerome Powell, J Powell out here controlling the stock market. Whatever he says, if he says something that's good, market goes up. If he says something that's bad, market goes down. He's very much in control of this market. It's kind of tragic to see, actually, but they came out with their FOMC meeting. Today is their last day of their meeting. He's doing questions and stuff. He did all of that and they're wrapping it up. But we can see their data, what their new points are looking like, and compare them to their old ones and seeing how the market's reacting. But before we get into that, if you are not subscribed, make sure to smash that sub button because we're on the road to 1,000 subscribers. But let's take a look at Jerome Powell's, the Federal Reserve's economic summary thing here. I had old and new, but I didn't realize that it literally tells you the last projections from the last one. So we'll just be looking at the new one here and seeing the big subjects that are highlighted here. Change in real GDP. This is a problem. This was not good. To go from 4% to 2.8% means slowing growth in GDP. Not good. You never want slowing growth. So it's something to keep an eye on. And then it goes through 2024 with slowing growth throughout the next 2 years. So this year, 2023 and 2024. So 3 years, but slowing growth, not something you want to see. Market did not like that, especially that it's more than expected. This 4%, if it would have went down to 3.5%, 3%, okay, maybe we accept that, but it's under 3%, not liked by the market at all. And secondly, the market hates this right here. 3.6% unemployment projection in 2024, which is a tick up, which is, why would it be a tick up in unemployment? Why are you expecting that? Is the GDP going to be so bad? Is the economy going to be so bad that, unemployment goes up? That's not a good sign when they're moving unemployment rates up. The market doesn't like that. It just means what's going on with the economy. Is it slowing down? Is it getting worse? Bad things ahead. And also, obviously, PCE inflation, core inflation. So this should take away gas and food, I think, although these are the exact same numbers except for this year. So pretty much the same. We do know their track record with inflation is not very good. So, take these numbers as you will. They think 2022 is 4.1. We're already at 7.9. Probably going to see 8-9% next month. So I mean, 4.1 means a pretty big move down to bring that average down for the year. Don't really see it happening. The interest rate hikes they're doing, I don't think is going to have a big effect, but 4.1, then 2.6, 2.3. I just think they're being way too kind of optimistic with this. Something like, why would inflation go down like this? Why would it go from 8% that it's at right now to 2.6%? That doesn't make a lot of sense. In just, next year. Maybe, it comes down to 5%, 4% or something, because substantial inflation time and time again is something that isn't really sustainable unless, we keep printing money like there's no tomorrow, which is an option apparently. So, and the final thing here is the federal funds rate. So that's the interest rate. Right now it's at 0 to 0.25%. There's a range. It ranges 0.25%. So their federal funds rate puts at 1.9%, basically saying there's going to be a 0.25% increase every single meeting that they do over 7 meetings this year. So that the range will be 1.75 to 2%, which is what 1.9 is in the middle of those two. So basically saying they're going to guarantee rate hikes every single meeting that they do, at least 0.25%. The market's pretty much expecting this, I guess. But again, with inflation at 8%, what do you think a 2% interest rate's going to do? And then 2.8% is just as high as you're going to go for the next 2 years. I don't know what that's expected to do unless inflation comes crashing down and comes down to 3% or something. Then what is 2% going to do? It's nothing compared to inflation, but we'll see how it plays out. The market didn't really overall like all this kinds of stuff. With GDP, that's a big problem. Inflation expectations going up, that's a red flag. And then core inflation going up as well from their previous projections although I still think they're lowballing it here. So I think inflation is going to be very prevalent and pretty bad unless they drastically increase rates. That'll bring down markets. And you might think to themselves, why don't they just increase rates? Do they really care about the stock market that much to increase rates? Maybe a little bit. But the biggest reason they can't increase rates is because of the debt that we have, which is massive. So this is the debt clock right here, showing us that we have $30 trillion in debt, and the interest rates for the government to pay that debt need to be pretty close to zero, because if we up interest rates to 10% to fight inflation, how are you going to afford 10% on $30 trillion? The interest payments alone could be $3 trillion. And I mean, you can see here, the federal tax revenue is 4.1 trillion. So interest would already take almost all of that. And we're already spending $6.7 trillion. That means the government is spending $2.6 trillion more than they bring in. If you add on 10% interest rates to this, they would be spending $5.6 trillion more than they already bring in. That just adds to the deficit, just compounds and gets this huge snowball from interest and the debt and payments, and it's just not a good situation. So eating away this debt through inflation is something that could be an option, but I don't even think we can eat it away as fast as the government is just throwing money away, because there's $2.6 trillion that is a deficit that happens every single year. The government just spends like there's no tomorrow. They might as well stop taxing us and just start printing all of the money and just see what happens at this point. And then a big thing is the U.S. 10-year Treasury Bonds. See if this is updated or not, but basically at 2.18%, it is on a massive spike up from 1.72%, massive spike to over 2. It is coming down a bit, though, or hovering. It was around 2.22 during the beginning of Jerome Powell's speech, but this is something that's affected by interest rates. Obviously, the higher the interest rate, the higher the yield could go. And when the yield's going higher, that actually means there's less buyers for the bond. When there's more buyers, the yield goes down. Less buyers, the yield goes up. And now the Federal Reserve might start dumping their bonds that they bought over the past 2 years, and that could force these rates to go up and bring money out of risk assets or even the stock market in general, put it into bonds. If this rate goes up enough, it would have to go up a ton, though. If inflation's 8%, I mean, you got to be pretty dumb to hold 2.2%. You're losing money on that bond at a real rate of 6 or almost 6%. So why would you hold that? It doesn't make any sense. That's how the bonds could tie into this a bit. And we all know the R word, recession, has been a big talking point, and it's actually spiked here. If you look at Google Trends, we've had a spike in searches for recession, people worried about it, a lot of fear about it. But is there really? So if we go back to the past 5 years, we can see the recent blip is really nothing compared to 2020, when we saw that huge crash and everything started in there. And then even compared to 2019, I don't even know what happened in 2019, but we see the massive fears in 2020, which ended up being a very short recession because the Fed turned the money printer on, put rates at zero, and just let it go. And now we suffer from the insane inflation because of the money printer. So, but just looking at that, it looks like there's huge fear over a recession, but you compare it to times past, and it's actually not spiking that much. Maybe we're at the beginning part here before a huge spike. Who knows? But it looks worse than it is when you zoom in on it and see maybe people aren't actually worried about a recession, because I think people have a little bit of discretionary money and income, but that could be eaten away pretty quickly through inflation. So we could see recession fears surge pretty quickly. And it's definitely a topic that is more searched or more worried about in even this past year. Let's see, past year, it's obviously a topic that's much more talked about and worried about now than before. So it's not something like, comparing it to the old ones, it's not very much of a peak. But recently, there's a lot more interest in like what happens during a recession, what happens to stocks, what happens to money, what happens to inflation, all these kinds of things that people are worried about. And just to end this video off with the S&P 500, how it's reacting to Jerome Powell, what he's saying and everything. Obviously, lots of volatility today, going down to 425, up to 434, ultimately kind of green. You see a lot of green here on the side, but what we're really looking for is to break this trend line. So this is the downtrend we've been on for the past couple of months. Breaking this and then sustaining it is what you really want to see a reversal if you're looking at the indexes and stuff. But right now, the market kind of liking what Jerome Powell is saying. We can zoom in 30 minutes and see it's kind of choppy, but for the past few hours, maybe enjoying what the FOMC meeting's been about and what Jerome Powell is saying during his questioning. So Jerome Powell is complete control of this market, apparently. I mean, the market really seems to care about what he's saying for his answers to his questions, what he's saying about actions to inflation, the interest rate hikes. Obviously, that's the biggest main concern right now, is the interest rates and how high they're going to go up and what inflation's doing. And the Federal Reserve has a lot of power over that. So we'll see how it plays out in the coming days and weeks and months. Maybe we're seeing the worst behind us, as, you know, the interest rate increases are just going to do what the market expects. That would be the best case scenario. But as always, remember to smash the like button and subscribe. We're on the road to 1,000 subscribers. I'll see you guys in my next video.